Hello and welcome to EY's second video on the IASB's IBOR reform project. My name is David Bradbery and you will be hearing from me and Tony Clifford as we provide you with an overview of the IASB's work so far, along with EY's view of how we see it. On the 26th of September 2019, the IASB published Interest Rate Benchmark Reform, amendments to IFRS 9, IAS 39 and IFRS 7, known as the amendments. This brings to a conclusion phase one of the IASB's work to respond to the effects of IBOR reform on financial reporting. Tony, can you provide some background to the IASB's work in this area?
Now, back in December 2018, the IASB added a project to assess the effects of interbank offered rate reform on financial reporting. The project has two phases. The first focuses on issues leading up to IBOR reform, up to when the financial instruments are amended to reflect the transition from IBOR to an RFR. And the second is then a second phase which will focus on issues arising once the amendments have been made. Now, the IASB issued an exposure draft of its proposed amendments for phase one back in May with an accelerated comment period and then issued the final amendments in September.
With phase one completed, the IASB is now shifting its focus to consider those issues that could affect financial reporting when an existing interest rate benchmark is replaced with an RFR. This is referred to as phase two of the IASB's project. At its meeting on the 25th of September, the IASB tentatively agreed the list of phase two issues and the preliminary timetable of future meetings when they will be discussed. The IASB may add to the list of issues and revise the timetable as their work on phase two progresses. We previously provided background to the IASB's project in EY's IFRS developments numbers 144, 145 and 152, which essentially covers the material we will be talking through today.
The amendments provide temporary reliefs which will enable hedge accounting to continue during this period of uncertainty before existing interest rate benchmarks are replaced with the RFRs. For IFRS 9, the amendments include a number of reliefs which apply to all hedging relationships that are directly affected by interest rate benchmark reform. A hedging relationship is affected if the reforms give rise to uncertainties about the timing and or amount of benchmark-based cash flows of either the hedged item or the hedging instrument. Now, application of the reliefs is mandatory. And the first three reliefs are as follows. First, and this is really relevant for cash flow hedges, the assessment of whether a forecast transaction or component relief is highly probable. The second relates, again for cash flow hedges, to when to reclassify the amount in the cash flow hedge reserve to profit and loss. And the third relates to the assessment of the economic relationship between the hedged item and the hedging instrument. For each of these reliefs, entities are required to assume that the benchmark on which the hedged cash flows are based, whether or not it's contractually specified, and for the third of the reliefs, the benchmark on which the cash flows of the hedging instrument is based, are not altered as a result of IBOR reform.
Thank you. And can you tell us more about the reliefs provided for hedges of components of interest rate risk?
So the fourth relief provides that for such a benchmark component of interest rates that is affected by IBOR reform, the requirement that the risk component is separately identifiable need only be met at the inception of the hedging relationship. Where the hedging instruments and hedged items may be added or removed to or from an open portfolio in a continuous hedging strategy, the separately identifiable requirement need only be met when hedged items are initially designated within the hedging relationship.
I see. And can you tell us about hedge ineffectiveness?
To the extent that the hedging instrument is altered so that its cash flows are based upon an RFR, but the hedged item is still based upon an IBOR, or vice versa, there will be no relief from measuring and recording any actual ineffectiveness that arises due to differences in their changes in fair value.
The corresponding amendments to IAS 39 are consistent with those for IFRS 9, but with the following differences. For the prospective assessment of hedge effectiveness, it is assumed that the benchmark on which the hedged cash flows are based, whether or not it is contractually specified, and or the benchmark on which the cash flows of the hedging instrument are based, are not altered as a result of IBOR reform. For the retrospective assessment of hedge effectiveness, to allow the hedge to pass the assessment even if the actual results of the hedge are temporarily outside the 80% to 125% range during the period of uncertainty arising from IBOR reform. For a hedge of a benchmark portion, rather than a risk component under IFRS 9, of interest rate risk that is affected by IBOR reform, the requirement that the portion is separately identifiable need be met only at the inception of the hedge.
The rules about the ends of relief differ depending upon which relief we're talking about. Reliefs 1 and 2, those are the two that you will remember relate to cash flow hedges, will cease to apply the earlier of two things. First, when the uncertainty arising from IBOR reform is no longer present with respect to the timing and amount of the benchmark-based cash flows of the hedged item. And secondly, for the first relief, which was about whether the cash flows that are being hedged are highly probable, when the hedging relationship that the hedged item is part of is discontinued. And for the second relief, which you'll remember is all about when we reclassify amounts recorded in OCI, when the amount accumulated in the cash flow hedge reserve has already been fully reclassified to profit and loss. The IFRS 9 economic relationship relief and the IAS 39 prospective hedge effectiveness assessment relief will cease, first of all, for the hedged item when its uncertainty arising from IBOR reform is no longer present with respect to the timing and amount of benchmark-based cash flows, and secondly, for a hedging instrument, when its uncertainty arising from IBOR reform is no longer present. Also, if the hedging relationship is discontinued before either of the two above events occur, this third relief, will cease at the date of discontinuation. Now, also, when an entity designates a group of items as a hedged item, the requirements that I've just been talking about in Relief 3 that cease, or in fact all the reliefs, are applied separately to each individual item within the designated group of items. These reliefs continue indefinitely otherwise in the absence of any of the events I've already described.
For the disclosure requirements for hedging relationships to which the reliefs are applied, entities shall disclose, firstly, the significant interest rate benchmarks to which the entity's hedging relationships are exposed. Secondly, the extent of the risk exposure the entity manages that is directly affected by the interest rate benchmark reform. Thirdly, how the entity is managing the process to transition to RFRs. Fourthly, a description of the significant assumptions or judgments the entity had to make in applying the exceptions. Fifth, the nominal amount of the hedging instruments in those hedging relationships. The amendments also provide an exemption from the disclosure requirements in IAS 8, accounting policies, changes in accounting estimates and errors, in particular paragraph 28F. As a result, entities are not required on initial application of the amendments to disclose for the current period and each prior period presented the amount of any adjustment for each financial statement line item affected.
The effective date of the amendments is for annual periods beginning on or after 1 January 2020. However, early application is permitted. The requirements must be applied retrospectively. However, any hedge relationships that have previously been de-designated cannot be reinstated, nor can any hedge relationships be designated with the benefit of hindsight.
At its meeting on the 25th of September 2019, the IASB agreed the preliminary list of Phase 2 issues. For classification and measurement, there were 4 issues. Firstly, whether a modification results in derecognition, and if not, how it should be accounted for. Secondly, if changes to reset dates and compounding could affect the SPPI assessment. Thirdly, if the business model assessment would be affected when a modification triggers derecognition. And fourthly, whether embedded derivatives may arise as a result of changes to reset dates and compounding periods for financial liabilities. For hedge accounting, there were 2 issues that were identified. Firstly, for hedge designations, whether a change to the hedged risk would trigger hedge accounting to be discontinued, whether flexible hedge designations could be permitted. The effect if some assets within a loan portfolio transition to an RFR and others do not, along with consideration of applying other qualifying criteria to new hedging relationships. Secondly, for the end of relief in Phase 1, how this interacts with hedge designations under Phase 2, and how amounts deferred in OCI should be recycled, along with how the valuation adjustments on a hypothetical derivative and fair value hedge adjustment should be treated if a change in the hedged risk does not require discontinuation. For other IFRS standards, what are the potential implications for IAS 19 employee benefits, IFRS 16 leases and IFRS 17 insurance contracts? For disclosures, whether additional disclosures should be developed. It was suggested during the IASB's September meeting that the discussion for each topic will not necessarily result in an amendment to IFRS, as in certain cases it may only be necessary for the board to clarify the accounting treatment it would expect under existing IFRS.
We commend the IASB for completing Phase 1 of its project to address these challenges, and in finalising the amendments, the IASB has provided reliefs that we believe will be essential to mitigate the hedge accounting issues that will arise during the period of uncertainty before contracts are amended to reflect the new benchmark rates. And by assigning the topic a high priority and completing Phase 1 in an accelerated manner, hopefully the IASB is ensured that there's a good chance that these amendments will be endorsed by the European Union in time for 2019 year-end reporting. We're also pleased that the IASB is starting to consider the various issues that will arise once the transition to risk-free rates take place. Now, given the outlined timetable agreed by the IASB, it's possible that we'll see an exposure draft sometime in the spring of next year, which would seem to suggest that the amendments to IFRS 9 and IAS 39 will be published probably in the third quarter, in which case they'll be available for 2020 year ends. As the transition from IBOR to RFRs is occurring at different times in different jurisdictions and for different financial instruments, entities may soon need to start amending the contracts. And the concern is that the breadth of Phase 2 means that there's a good chance that some of the solutions might come too late for entities to address the accounting challenges that will arise. The IASB obviously must continue the momentum it has generated so far and attach the same urgency to resolving the Phase 2 issues as it did with Phase 1. But one possibility that has been raised by a number of constituents is that they should possibly consider whether to divide the Phase 2 list into two and to fast track some of the more urgent issues to be able to deal with them more quickly.
Thank you, Tony. That concludes the video. We hope you found this useful and thank you for watching.